Hello, everyone. Welcome to Accounting 150. This is the first principles of financial accounting, and this is our first chapter and first discussion together. So, hopefully, this will be the first of several our meetings where we will use PowerPoint slides, which you can download as well. Follow along if you'd like, or to make notes. Those are also available, but this will be kind of narrated or described as we would if we were together in the classroom. So, really, as an introduction to our accounting, we need to answer that question that's on your screen. What is accounting? And kind of why do we need to understand it? To do that, kind of a little introduction, we're going to I'm going to send you in the next slide over to a video that shows the story of Phil Knight, who takes a passion for running and running shoes and builds it into a name you all recognize, and that is Nike, one of the most recognized brands in the world. It's not completely an accident that his background, his training, he went to college and learned accounting and became a CPA before he did any of the things with Nike. And as you watch that video, you'll see several times where that could play a part in the sense that he was able, when he approached those that are at banks or lenders, to ask for the loans he needed to grow his business, because he needed, what his basic idea was, is that he could have the shoes made in Asia cheaper and with at a higher quality, and then bring them to the United States. But the risk that had back then, especially, was that meant he had to pay for them. He had to somehow have the money to pay for them. There was no way that he could wait until he sold them to pay off those who made them in Asia. There's too much time differential between the time they are made and when they get sold, based on shipping and all of the other things. And he had no reputation, and that's one of the big things about. There's no way that someone could know that he was going to pay them back, meaning he had no history of paying those debts back. And that's one of the things, that just one aspect of accounting that is interesting and is part of the decision making process. So it certainly benefited him as he began and brought in, other partners, investors, to understand the accounting and what information they would need and how they would interact as investors with the business. And much of the language that is used in that interaction is accounting language. So I hope you enjoy that, and it gives you some real world insight as to the process by which accounting informs business and business decisions and investor decisions. So when we say what is accounting in this class, as we talk about what the way that we're looking at accounting, and there's more than one aspect of accounting, you might say. And so we have a separate class that is what is referred to as managerial accounting. This is financial accounting. And the difference really is, who are you communicating information to? Accounting is always about communication. The question is, who is your audience? And with financial accounting, our audience is those outside of the business, not those inside the business. So you might guess that managerial accounting is for managers, those that are inside the business making decisions. Financial accounting doesn't give you the same kind of clue, but it is communicating outside of the business to those who are making financial decisions that direct in that way. So two things that I hope that you'll keep in mind as you think about accounting as we learn about it this over the next 7 weeks is accounting is first of all a language, often referred to as the language of business. Notice I did not use the term math or anything like that. It's not fundamentally about adding and subtracting or any arithmetic or any mathematical formula. It is fundamentally about communication. We use a lot of math to help us communicate, but the key aspect of it is communication. We want to communicate the financial wherewithal or the financial health of a business to those outside of the business who need to understand how it's doing in order to make decisions, important decisions about investing, lending money, that sort of thing. So we're always asking ourselves, what we're doing with this accounting is, what is it communicating? What is it saying? What is the story that it's telling? And for anybody to understand any language, there has to be some rules. Whether you're learning a new language like German or French, as it says in our little, picture there on our slide, all of those languages have rules. They have vocabulary. They have terms, and those terms mean things that are fairly specific. Sometimes there are multiple terms that mean the same thing, and that can often give you a hint as to its importance. And sometimes that's the same case with accounting. We have a lot of terms, some of which will be unfamiliar. Some will be familiar, or at least you'll think you are familiar, and we may need to clarify the definition of and how we're going to use that term in accounting, because often accounting terms are used by those who have not been trained in accounting, don't have an understanding, and they often will use them incorrectly or at least differently than how we would use them as in an accounting setting. Okay, so we have to correct our definitions in a few cases as we move along, so that we're all on the same page and we're following the same rules. That's what's important about communicating. If I'm going to decode your message, I need to understand the rules by which you used in encoding that message when it comes to communication. The second thing that I think we really need to make sure we understand is accounting is a decision-making tool. It is how we gather the information we need to make decisions. And so financial accounting, the primary decision makers that we are focused on, that we are asking ourselves, what do they need to know, are what we refer to as investors. They are using the accounting information, their understanding of the accounting information to manage risk, and we'll talk more about risk and what that means, and seek a return, meaning they've put money into a business or they have invested and they expect to get more than they put in back. That's the point. That's what the expectation. That's what they are looking for. And measuring that is what accounting does. Giving them a hint as to what the future is what accounting does. Telling them how a business has performed in the past is what the accounting information is providing. All of which helps them make a decision based on what they see the future to hold with regard to their investment. All right, so we graphically try to represent this in terms of a picture. Business owners and managers, if you were to really distill down what makes a business successful, it is making decisions. So if you were to look at what it takes to be an entrepreneur or a business leader, they make decisions. And if they make them correctly, then they are typically going to be successful. And these decisions can be all kinds of things, like from who to hire, what products to offer, what to charge for them, who your customers are, what, where you should build your building, how much you should pay for this input or that input. All of these business decisions, and there's hundreds or thousands literally that are made, sometimes over and over again, every single day even. All of these decisions require information, and you could say that all of them require some form of accounting information. And so they look to accountants to do two things. A, provide them with this information they need to make their decisions, but also to translate their decisions into accounting language. So they may make the decision based on, English in our situation, and the description of what's happening with the business. Accounting is going to translate that into accounting language using the rules, using the vocabulary that is common to accounting, and then communicate that. They're going to take that and make accounting decisions to reflect the business and then communicate it to the investors or lenders. So the bank may want to see accounting information based on business decisions. So if the business owner is making successful business decisions, they're hiring the right people, they're selling the right products, they're solving the right problems out there, then it will be reflected in the success financially that is measured in an accounting setting. And you should be able to see that as an investor or a lender when you read the accounting information. You should be able to understand the story, read the story of the business's performance, and in some way translate that into what you think is going to happen in the future. Now, the accountants don't typically do that, at least not for the investors or lenders, but they can take information about the past performance in order to see what is going to happen in the future. But those investors influence the business owners. For instance, if an investor is going to put money into the business, they're going to probably want some say in some of the business decisions. And the business owner, knowing that, may make decisions based at least somewhat on what they think investors or lenders want, what they want to see in terms of financial performance. All right, now not everything, but you can see that they're all interrelated. So the accountants are fed information from business owners and managers based on their business decisions, but accountants are feeding information back to the business owners and managers that are influencing their decisions. And vice versa, also with the investors and lenders. They're communicating, and the investors are asking questions, and lenders are asking questions. as a CPA myself, I often will get a question about financial information from a bank based on a company or a business that I'm involved in or have had a role in doing some of the accounting. The question may come as to what, how things are performing. Maybe a clarification of the financial information. So it really is interrelated in a full circle as to they all influence each other. And right in the middle are we accountants of all of this. And one of the key ideas is that if we're going to be part of this, we have to have what we refer to as integrity, or the ability for everybody to trust the information. So if information is the key for all these successful decisions we made, then everyone involved needs to trust the information such that they can make decisions. And the result of not trusting information is usually decisions don't get made. Businesses don't get started. They don't expand. Investors don't make investments. All those things are revolved around if their trust in the information, which obviously, I hope, indicates the great responsibility to live up to that trust as an accounting profession. So, promised that we would talk a little bit more about risk, because that's part and parcel of our accounting information. Remember, accounting information is used by investors to manage risk. Now, let me be real careful. Risk is a chance the outcome will fluctuate, good or bad. Risk is just the possibility that what you anticipate is not going to what really actually happen. And risk and return go together. Some people will claim otherwise. They will say that you can have a high return and low risk, meaning you can get a lot back for your money, meaning you put in money in for investment, it will pay you a lot back, and that it is somehow guaranteed. That is almost always a lie told by someone who is trying to sell you something that you probably should not buy. Risk and return just go together. The higher the risk, the higher the return, or at least you should anticipate that. All right, they go together. So let's think about some traditional investments that you might make if you had a sum of money, perhaps, that you didn't need to spend on your living needs. So you had an inheritance that you were looking to invest. You could go to the bank, open up a savings account, and make maybe 3% return. And that's often how we measure return, is by saying it's a percent of how much we invest. And that literally means that over the course of a year, if you had $1,000, you would earn 3% or $30. And at the end of the year, you would have $1,030. If you do that at the bank, your risk is pretty low, because savings accounts have what's referred to as FDIC insurance. Even if the bank, first of all, the banks are watched carefully so that they don't get themselves in a situation where they can't not pay you back, because that's what it is. If you put money into a savings account, that's your loan to the bank, which is why they're paying you interest Just like if you borrow money from the bank, you pay them interest. The bank is paying you interest for having your money, because they're going to turn around and take that money and invest it. They're going to loan it to people in terms of buying a house or a car or something like that. So that savings account's got a low risk. 3% is a fairly low return as well. Now, other things you could invest that money in. You could buy stock in a company. You could buy, you'd loan it to a business other than a bank that doesn't have the oversights, that does not have insurance to cover if they can't pay it. You have no promise if you buy stock in, say, well, we'll use Nike since we watched our video about a little bit about Phil Knight. If you were to buy stock in Nike, there's no insurance, no third party that's going to say, well, if Nike doesn't do well, we'll cover you, like there is if the bank doesn't do well. So there's more risk, but you would also anticipate more return. Okay, and that's what Nike has to basically provide. They are going to say, well, yes, we understand there's more risk, but we also offer the possibility of a higher return than you would get for 3%. But it may not be, it may be lower than 3%. It may even be negative. Okay? So investors are looking to predict the future for Nike, how successful they're going to be, how much risk is going to be there that they will not reach their financial goals. Okay, there's no way to take risk out of it. There is never zero risk. There is always a risk that you need to manage. And the better your information, that's what we call transparent. Transparent information, when we're talking about accounting information, is information that truly shows what's really happening with the company, what story is really happening with the company. You haven't obscured it, okay? When we talk about something obscure versus transparent. Transparent, you can see through it. You can see through the accounting information and see the story. Obscure means that, there's a lot of information, but it really doesn't necessarily reflect what's the real story. Maybe it's been doctored up a little bit to look differently. Okay. Now, how does someone make money by investing in stock? Remember, that's the risks and return we're talking about is generally, we're talking about investors in two senses: those that are lending money to a business and those that are buying stock in a company. And buying stock basically is the idea of buying a piece of the company, meaning if the company does well, you do well. And how do you do well with that investment? Two things potentially could happen. Okay? You could receive dividends from the company. Companies pay dividends, and that's their way of sharing their net income or profit, the money that they make. They share with those who have bought a piece of the company, because that's what you get when you buy a piece of company. You buy a right to receive part of the profits. That's the deal. So that is the form that will take in this class and in all basically accounting scenarios, is that will be in the form of dividends. Now, the other thing that can happen is the business, if it grows or is successful, it can become worth more. So the business that you bought at a certain price, as it grows, gets bigger, is more successful, it becomes more valuable. And so your piece, your small chunk or big chunk, whichever it is, of the business also is more valuable. And therefore, you could sell it for more. Now, of course, whether you can find someone to buy it is another story. And one of the things about companies like Nike, who is what we call publicly traded, which means that each day there is a market where investors buy and sell Nike stock. If it's the neighborhood pizza shop, they are probably not publicly traded, have not gone through the process of that, which is very complex and not an easy thing for Nike to be a publicly traded company. There's a lot of requirements for that. The pizza shop could still have investors. They could never have a lot of investors. They could have a few because they would not be publicly traded. They could not sell it to just anyone. It would have to be a very specified group. Okay, so you invested in that pizza shop believing in that concept, perhaps. Maybe you bought 10% of the stock. If that pizza shop grows, and you may be able to sell it, that you're 10% of the company for more than you paid in, but only if you can find someone else that believes in the pizza shop. Okay? There's no market with a whole bunch of buyers and sellers. You just got to go, look around, which obviously becomes a lot more difficult. Okay? It's the difference. It really is the difference from selling. If you were trying to sell something valuable by setting it out on your curb, okay? I'm not talking about junk, or even, we're not talking. We're talking about something valuable. Put it out on your front porch and hope the right person comes along, versus listing it on eBay or selling your products on Amazon, where there's all kinds of buyers and sellers already. Okay? So, the better the information, lower the risk, okay, or you manage the risk, or at least know what the risk is, because that's the hard thing. You anticipate the risk, you anticipate there's a possibility it can go up or down, and then it happens up or down, and then you can tolerate it. It's when you anticipate one thing and it doesn't, you're completely wrong. Okay? We look at past information as accountants, as investors. We look at how Nike performed last year, the year before, to try to predict what the ups and downs are going to be in 2026, this next year, when it will face, some similar challenges, some different challenges. But companies that have been successful in the past are more likely to be successful in the future. They have the right people in place. They have the right ideas. They have products that are well recognized. So that is something that's going to carry over unless something dramatically changes. And of course that can, but it certainly is better to know that they have been successful in the past than just relying on, oh, that name sounds really cool. I have no idea how they performed in the past, but I'm sure they're going to do well in the future. That's a very risky, low information type of scenario for investment. So just to illustrate, a publicly traded company like Nike, each day we can track the buying and selling, and this is the price. You see, okay, that over the course of the last year or so, they have gone up and down as more people have wanted to buy or sell until you see this point where it really drops. And you see down here is how many people were buying and selling in terms of investors. And there was a big lot of buying and selling right here and right here. Okay, that's not what you like to see, price dropping, but if you had believed that the future was bright still, then you might have bought there and sold when it got up higher here because it's more valuable. Because people thought, this is a more valuable company than it looks like right now. And so, and everybody figures that out, then the price will go back up. Okay. Also, there will be dividends paid at certain points during the time frame when you will know that they're going to pay it. So there's dividend was announced for June 1st. That's when, if you own the stock, you will get the dividend called the X date. So buying a share of stock in Nike provides us, stockholders, investors, ownership. Small piece, because there's millions of shareholders, millions of shares, and allows us to share in the profits in the form of dividends. So our questions that we would be asking ourselves as we were thinking about investing, buying stock, is will Nike have the cash and the profits? Will they be successful enough to be able to continue to pay dividends? If they don't bring in more money than their expenses, then they will have no profits to share. And will they grow financially in a way that will make the company more valuable? And therefore, we'll be able to sell our stock for more than what we paid for it. That's the constant question going through each investor's mind. We know that as accountants. The business of Nike knows that that's what people are wondering. So they are trying to show in their business decisions and cash decisions and in their accounting decisions that this is a situation that you want to invest in and that it is going to be successful in the future. You saw in the chart that the recent past has not been too stellar. So it's going to be harder to convince investors that things are going to turn around, that things are going to get better, right? Because we assume that the past is going to probably predict the future. And the past has shown that the things haven't gone as well as we'd like, especially reflected in the price of the stock. All right, so we talked about publicly traded companies. Nike required to communicate their information, okay, according to some very specific rules. That's one of the things about being publicly traded, like Nike. If you're the pizza shop, okay, you probably do not have to follow the same set of rules. You don't have to follow the same detailed rules that Nike does. Nike must do that or they cannot sell their stock. We'll come back to the governmental entity in Chapter 3 that enforces that, provides for that, who you send the information to, and checks to make sure that you're following the rules. So, different set of risks and for a Nike that has these rules to cover it, than the pizza shop, which does not. You would have to have a different way to feel like you could trust the information the pizza shop had provided than a governmental entity looking over, reviewing the information. So your textbook talks about accounting information is complex enough that sometimes even the numbers don't quite tell the full story. And so we need some explanation that will give us that. And here is an example of what's called a press release, an explanation. And we noted on the chart that we're going to pay a dividend, and that's what this very short explanation. But you see, while there's a couple of numbers in here, there's also some explanation that goes along with it to help us understand some non-financial information as well. Okay, for instance, that you have Class A and Class B common stock, two types of stockholders, maybe with different rights in how they share the dividends or how they share the profits. The date is non-financial as to who owns it. So, financial information, 41 cents per share, which means if you own a share, you get 41 cents. This is at quarterly, so it sounds pretty piddly, but it gets a little better if you think that that's going to happen 4 times a year, not just once. And much more detailed, we won't spend too much time on, but you can see that it goes down and explains their financial information for the fiscal 2026 third quarter. And you see, while there's a lot of numbers, okay, they're talking about whether it went up or down, different types of information, a lot of explanation, and of course, you've got Nike's kind of rah-rah cheering themselves on. We took meaningful actions to improve the health and quality of our business. Pace of progress is different across the portfolio. It means some parts of our businesses are doing better and some are not quite getting there. And the areas we prioritize continue to drive momentum. So we've chosen the right things. We've made a right decision to build on certain parts of our business, and they're going forward. They're driving momentum. The work is not finished. That's why numbers are still not up. Okay, there's still a lot of decreases. There's a lot of revenues that are down, which are sales that are down. But direction is clear. Teams are working forward. Our foundation is getting stronger. Okay, so there's a non-financial information explained to you. It doesn't have anything, doesn't give any dollars or cents, but it does give you some rationale. And you have to decide, well, is that believable given the information that I see in the financial statements, the accounting information. Okay, so just a quick look at some non-financial information there. It goes along with financial, helps us understand more detail. You could spend more time on this. Is just our last few slides here are going to look at what we refer to as the annual report. This is the primary way that companies communicate their financial information. You see here it's quite long, but our focus is really on the accounting information, a lot of non-financial information, a lot of words and things. But we're going to, in this class, and that's where the term comes from, this is a financial accounting class, and we're going to focus on financial statements and a little bit on supplementary data. Okay? So that is one piece, item 8, out of a report that is almost 100 pages long in terms of how the company is doing. And these are the financial statements. You can see the kind of questions we might ask ourselves or ask from the information. What has happened to sales over the past year? That's why we're given 3 years of information. Not just one. We can compare what happened for the last 3 years. Okay, you can compare to the year end, 2025 to 2024. And of course, there might be some real concern that revenues have dropped, meaning they sold less shoes. That's not usually something to be real excited about. Okay, but you see the idea of time period that this happened. Okay, you can see that they use it to compare. You can see the types of information that we are trying to capture from a financial statement or accounting information standpoint. Assets or a balance sheet. What resources does Nike control? These are the assets that they control. And what do they owe to others? Liabilities. We'll dig more into these definitions in Chapter 2 and the structure and the actual rules with how these financial statements are laid out in Chapter 3. But for now, we're just kind of getting a taste of what this accounting information looks like, what it communicates, the questions that we're trying to answer. How much of the stake do the shareholders have in the company? What is their piece of the business? So they can start judging how much that might be worth. And the last just glimpse, how much cash did Nike bring in? How did they spend it? What did they buy? Okay, are they putting that cash to work in the business? We don't want a business just hoarding cash. That's not a very good investment. You don't invest in a business for them to take your money and turn around and just put it in the bank. You could do that yourself. You want them to do what they do well. For Nike, that's make shoes, sell shoes, make clothing, sell clothing, that sort of thing. Okay. And where do they spend the cash? Some of it went to pay dividends. Some of it may have bought new property, new factories, that sort of thing. All of which you can get an idea from this financial statement. So we've looked at 3 just really briefly. There's a 4th that we'll learn about in Chapter 3 as well, that ties them together. But this is just the taste. We'll have also an opportunity in a discussion post to make observations, because even at this early stage, it's not too difficult to start seeing basic ideas about the information that's being communicated in these financial statements, in this accounting information. You don't have to understand all the story to be able to see pieces of the story from what's being communicated. And this is really the basis of what we're going to learn all through this term, is these financial this communication, how it's communicated, what the story is being told, how these are structured, how we can trust them, how they get the information to communicate, so that we can actually make these investor decisions with regard to this, to Nike or any company that we have this information for.